Good morning, everyone, and welcome to the latest in our series of Retirement Plan Academy webinars. My name is Zach Hurst. I'm joined on screen here by Kevin Fillers, my colleague at the Trust Company of Tennessee, and Josh Itzo, who is joining us from Baltimore, Maryland. More on those two in just a few minutes. Before we jump into this, I want to cover a couple of housekeeping items. Number one is, hopefully a lot of you have been with us before and know this, but there is a questions box somewhere on the screen you're looking at that looks different than mine. But if you want to find that and input any questions that you have now, as we go, at the end, whatever it might be, we'll try to get to those as soon as they come in. If we can't do that, we'll certainly save time for the end to do that. Also, there is quite a bit of CE credit with this webinar. We have 1 hour of SHRM credit, 1 hour of HRCI credit, and 1 hour of CPE credit. I've got to turn to my cheat sheet here. As always, on the CPE, there are a few things to cover on this piece. So for those on the call who are seeking CPE credit for this, a few little tidbits here. Number one is we do have 3 poll questions that we're going to introduce for the audience. Obviously, we want everybody to partake in those and have a little fun with those, but those that are seeking CPE credit will be required to answer those. You must stay for at least 50 minutes. We'll try not to go much longer than that anyway. And a reminder to fill out the evaluation form at the end of this in order to allow us to send you an email afterwards and get you what you need. So with that, gentlemen, we're going to show our faces one more time and just some quick intros here. Again, Zach Hurst with the Trust Company of Tennessee. I am in our Chattanooga office and a certified financial planner working with a number of 401k plans in the Chattanooga market. My colleague Kevin Fillers is our 401k expert out of Knoxville, works with a number of our plans really throughout the state of Tennessee. Kevin, I was going to say just Knoxville, but you're really across the board there. And our special guest today is Josh Itzo. And Josh, I'm going to use my cheat sheet here for a minute. The one thing I do know about you, because I just read this book for the second time, is that you have written 2 books, bestseller in there, The Fiduciary Formula, which is an awesome book for plan sponsors. Quick read, easy read, good tidbits, and Fixing the 401k. Josh is was the co-founder, partner, and chief strategy officer for Greenspring Advisors, one of the most well-known retirement plan advisory firms in the country. And Josh, since then, and this is where I want you to jump in and help me out a little bit here, because since then, you have founded and are the CEO of Fiduciary Works, as well as Fee Metrics. Do you want to tell us a little bit about what you're doing there?
Sure. So, you know, I came to this existential place during COVID, like maybe other people, but felt like, you know, it was time to, after having built a successful advisory firm, I felt like the opportunity for me, this next phase of my career, was really to try to help more retirement plan advisory firms and also more plan sponsors. So Fee Metrics is a tech platform that I built. It's a fee benchmarking platform for retirement plan advisors and plan sponsors. And there's some other tools that are launching as well as part of that. And then Fiduciary Works is really a consulting advisory firm where I can work closely with, you know, firms like the Trust Company of Tennessee and also counsel to retirement plans in some capacities, things like advisor searches, fiduciary training, and so on and so forth. So that's where I spend most of my time and most of my days now.
Good. Well, thanks for joining us today. It's going to be a fun topic and an important topic here, and you see the agenda that we have on the screen, and then I'll launch a poll question in just a minute. But today's agenda is going to be really focused on you, the plan sponsor, or you, the person in your company who is involved in some way, somehow, some shape with your 401k plan or your 403b or any retirement plan. And it's really, does your plan help with the 3 R's, right? So recruit, retain, and reward. And then the benchmarking that we just talked about, Josh, the 3 F's, the features, the fees, and the funds. So making sure that we're all doing our jobs, us as providers, and you all as plan sponsors or some sort of fiduciary role within your plan. Guys, before I launch the poll question, this is true. This is just very timely. I had a call with a prospective employee yesterday, and we were going through our conversation, and within 5 minutes, she asked me about the benefits that the Trust Company of Tennessee offers, and it was after hours call. And so she said, for the sake of time, all I really care about are the health benefits and the 401k. I said, well, interesting, because I just reviewed these slides with you guys a couple of days ago, and I said, well, that's a lot of what we're going to talk about is how important this thing is to prospective employees and certainly to current employees as well. So we'll get into much more with that. Lindsay, who's behind the scenes, if you will launch poll question number 1 for the audience. And it is opening now. And I've got a small screen here. Let me try to read this. The question is, does your plan help you recruit, retain, and reward employees? Yes, no, or I'm not sure. Certainly, if you answer no or I'm not sure, Josh, I think they found the right place for this today. Is that fair to say?
I would believe so.
We hope so. We hope so. So we'll give just a minute here and get those answers in, guys, and then we'll jump into the next few slides here and really start to cover the features of a 401k plan and talk through some of that. So just one more second here. And here we are. We're going to share the results. Yes being the main answer. That's great. That's what we want to know. And we hopefully have clients on here. So that's certainly what we want to see. A few no's and quite a few I'm not sure's as well. Of course, it's hard to know exactly if you're offering the right things, right? This is just a fraction of your job as a plan sponsor. So it's our job to know what industries or what's happening across industries and what the trends are across industries and if you're keeping up or not. It's hard to know in your seat if what you're doing is what others are doing or not. So we're going to try to help with that today. So Kevin, I think you found this great sign out there somewhere, and we're looking at some sort of a trucking service company, and you see really across any industry, this one is highlighting it as well. We're talking about the importance of what people are offering between benefits and even highlighting the 401k. So I think that really touches on what we're going to cover today.
Yeah, I mean, this is a local trucking company, probably 10, 15 minutes from the office. I was driving past, turned around, came back, snapped that picture, because I mean, I think this sign fully illustrates that, 401ks are considered to be one of the top benefits right now. It used to be healthcare. More and more that's coupling on 401k and healthcare. So employees are really, especially in this market, looking at what do you have to offer me, because there's so many jobs available. Prospective employees can be picky about what they're looking at and what they consider to be the top benefit or the top driver for them. I mean, would you not agree, Josh?
No, absolutely. There's a number of studies that recently, a few of them I cite in my book actually, one by Fidelity, one by Glassdoor, that are showing that, I think over the past 10 or 15 years, companies have really focused on healthcare, and in many cases, employees are pretty satisfied with healthcare. That's always typically been the most acute, kind of highest priority benefit. But I think what we're seeing is trends are starting to change, where retirement is actually starting to take more of a higher priority in the eyes of employees when it comes to, attracting and retaining employees. And as you mentioned, the fight for talent, and we see it, right? We see it across the country. We read about it in the media, is that, many companies are just having trouble hiring talent. I know around me in Baltimore, I've started to see that, restaurants are offering 401k plans and matching, and that's typically, in a lot of cases, you're seeing companies that didn't offer these types of benefits in the past that are starting to offer them because they want to try to be an employer of choice, and it's just a really competitive environment out there.
Yeah, and I think a good point that in a conversation you and I had the other day is that, you can't just offer, there's not just a blanket 401k plan out there that you can offer. As an employer, you need to be intentional about the 401k that you're developing based off of your demographic of the type of employee that you're hiring. So again, you need to be very intentional when you're developing that 401k and really make sure it fits the demographic and it fits your business, your industry.
Right. Yep. And works within the capabilities and the resources that you have as a company. And I think we're going to get into that as the presentation continues. Is you have to start with the end in mind, and the way you design your plan is it needs to be intentional, because in many cases, a lot of companies just take a cookie cutter approach, and the goals and objectives they may have, they do things that don't necessarily drive the outcomes that they intend. So we'll talk a little bit more about that as we get into the presentation.
Yeah, perfect. And one thing to note for the plan sponsors on the call, I've really never seen this highlighted before, right? You see things about 401k and match. This one has an all bold letters profit sharing, right? So I mean, people are having to get even more aggressive in terms of what they're offering versus what we're seeing 5 and 10 years ago. And this is, maybe I'm just speculating on this. I don't think this is an industry that we're looking at right here that typically offers a lot of profit sharing. So just really interesting note on that sign as well. So with that, Kevin, let's jump in. We're talking about the employer match and just sort of some of the features of what we're seeing across the board and different ways that you can go with this. So why don't you tell us a little bit more about the employer match and sort of some of the more common areas where they do this and some of the places where not quite as common.
Sure. So as you can see, there's several different types of matches available within a 401k. You have a traditional match, which is it's basically the stated match, 100% of the first 3% that an employee puts in. You can have what's called a stretch match, where that would be when you put in 6%, the employee's going to match you up to 50% of that. So if you put in 6, you get 3. So that's just incentivizing an employee to put in more money of their own money to get that employer match. You can have that tiered match, which is typically the safe harbor. So it's a formula, 100% of the first 3%, 50% of the next 2%. So if I, the employee, put in 5%, the employer matches me 4%. There's some other safe harbor match formulas, but that's typically the most popular one is called the basic safe harbor. And then you have a fixed dollar match, which is exactly what it is. It's just a fixed dollar. Once you put in that certain amount, you just get that amount. And you can look at the popularity here of those types of matches based off this pie chart. And then we have some data to support that on the next slide. But Josh, is there anything that you would add on the different types of matches available?
So and this is where we start to get into the intention. So, for instance, plans that may have testing issues, right? That nobody likes to have a testing failure because you have to typically refund, your highly compensated employees, what they had put in. Nobody likes that conversation when you go and say, hey, we failed testing, so you have to take money out of the plan. Something like that is typically the focus, or I really look at these as more of kind of tools in the toolbox. Something like a safe harbor where the trade, it's kind of a give to get, if you will, right? The government says that if you're willing to do this, what you get from it is you're going to be exempt from testing. So safe harbor. Stretch is another way, and there are some types of stretch matches that you've seen companies take where they say, okay, instead of, let's say, 50 cents on the dollar up to 6%, we're going to do 33% up to 9%, and it works out to the same amount. And that's something that you need to realize, that there are ways to stretch your match and design the formula so that you control your spend, but what you're trying to incentivize is people to put more money in. When people defer more money, and if they have to defer more money in order to maximize the match, that's going to drive up their deferral percentages. And that's another way to, over time, it doesn't usually happen immediately, but over time, you can drive up deferral rates that can help cure plan testing issues.
And what we've seen out there too is sometimes employees feel like, well, whatever the company sets the top of the match at, that's what I need to put in, which is really not true. I mean, data supports now that employees need to be saving between 10 to 15% right now for retirement. So if the company's maxing out at 3% and you only put in 3, you're falling short by almost 9%. So,
and that is the most important. What I would jump in and say is, the Apostle Paul years ago said that love covers a multitude of sins. Well, what I would tell you is that the savings rate covers a multitude of financial planning sins. That is the number one when you're designing your plan, and really with a focus on how do you help your employees retire with dignity and not in despair. The single most important driver of retirement success is the savings rate. You can have bad investments, you can have high fees, but if you have a really strong savings rate, that's really going to be the key driver. And so you can invest your way out of a savings deficit. And so, as we get into the presentation further, certainly there's the match. There are things like vesting where where again, you can drive outcomes around what your goals and objectives are. But we're also going to talk about things like automatic features, automatic enrollment, automatic escalation. And these are all tools and levers that you pull in order to drive outcomes over time for your people. Because, I would say I'm going to be 50 in a few years. They always say, what, 50 is the new 40? I would say that 15% is the new 10%. For a long time, you heard that 10% was kind of that magic number. With people living longer, we see it, right? Inflation, whether you believe it's transitory or not, from what the Fed tells us, the cost of living is increasing. And so I really do believe that your goal as a plan sponsor is to design your plan with intention in order to get your people into probably that 15 to 20% total savings rate. That's not meaning that they're saving 15%, but that, let's say you do the tiered match, as Kevin mentioned, and if somebody puts in 5, they get 4. If they put in 10, they get 4. 4 would be kind of your maximum exposure from a matching standpoint. You really want to get people into that probably 11, 12, 13% deferral rate, because the combination of what they put in and what you put in is going to get them in that 15 to 20% range. And that's where automatic features come into play. Most of financial planning, most of saving for retirement, it's not knowledge, it's not information, it's behavioral. And there are ways that you can supercharge your plan from a behavioral science standpoint to help people's behavior and inertia, help them overcome the challenge of saving and get them moving in the right direction over time.
Yep, and I think a takeaway on this is you see, these different types of matching formulas that you have out there. This is not a pie chart to show you where you should be or what the most popular are. It's just to point out that there are a lot of different ways that you can go, and the makeup of your employment is really what's going to drive that. So with that, guys, we're going to get into some stats about this that Kevin mentioned. But before we do, Lindsay, if you could launch poll question number 2, because this does relate to match percentages. And there you have it. And this is, what is your current match percentage? Is it less than 3? Is it between 3 and 4? Between 5 and 6%, or greater than 6%? Josh, you're the expert. What's going to win?
I would say the current match percentage probably falls in the 3 to 4%.
Kevin, agree?
I would agree.
Yeah, and that's probably because, guys, I think the most common formula that we see out there, particularly with Safe Harbor, is the as much as 4% match. Is that correct?
Yeah,
Yes.
I would say the most popular one you see out right now is the basic Safe Harbor match.
Okay. Yep. And again, here we go. Actually, poll results are coming in now. So this is going to be less than 3%, quite a bit, 31%. 3 to 4% is the most at 42%. And then you see a spread between 5 and 6% and greater than 6%, which is outstanding. Guys, honestly, this is a bigger spread than I thought it was going to be between these 4. So that's great. And a lot of different plans offering a lot of different great benefits.
You put us on the spot, Zach. I was a little nervous there when
the
results.
Well, you won. You still won. It's okay.
Well, just by following the data that's on the next sheet, you can see across all industries, 4% is your highest rate at about 28.6. And what's interesting to me is to see that as you go upstream to these larger plans, 4%, 5%, and 6% are really the winners as you even go up into what we call our large market plans, between over $1 billion. You see those stats stay the same. That was pretty interesting to see that.
Yeah, it is. And we're going to show quite a few charts like this. So I just want to take 1 second on this. Let's focus on, I don't know if you can see my cursor or not, probably not, but on the left side of the page, it says all industries, and that's what Kevin was talking about. So across the top, you're seeing the size of the total assets. Kevin, is that right?
Yes.
Within the
total
plan?
assets in the plan.
Yep. And then you see, I assume that this is the match percentage on the left side, 1, 2, 3, 4, 5, 6%. And then we're showing, as Kevin just mentioned, going across as asset sizes get bigger, what happens to those numbers. So just keep that in mind, because we are going to look at quite a few of these pages. And the other piece that we talk about a lot is vesting, and that's actually been a pretty hot topic here recently as well, particularly as people explore more safe harbor options. But Kevin, do you want to walk us through vesting?
Sure.
And what we have on the sheet?
Yeah, so first type of vesting we'll talk about is safe harbor and the requirements for that. So basically on any safe harbor, uh, matching or safe harbor non-elective, you are 100% immediately vested in that match or that non-elective contribution that the company's giving the employees. Then
Kevin,
our
can I just
next,
jump in real quick on the safe harbor? There is one caveat to that. It's what's called a QACA plan, a qualified automatic contribution arrangement plan. So that is a safe harbor plan that includes automatic enrollment and automatic escalation to certain, and you have to kind of achieve certain targets in a certain time frame. If you implement a QACA, it does give you the ability, if you to turn it into a 2-year vesting schedule. So it's still probably somewhere, it's more rare within the industry, but that is the only caveat to the safe harbor. Generally speaking, as Kevin said, you're going to have to vest those dollars immediately for your employees.
yeah, and Josh, I've been in this industry now 13, almost 14 years, and I don't think I've ever come across that type of safe harbor. How often have you seen one?
Yeah, I had a few clients. I was always a really strong advocate. My first book in 2008, Fixing the 401k, that came out, that was right after the Pension Protection Act of 2006, which was really the legislation that kind of greenlighted these automatic features like automatic enrollment, automatic escalation. And kind of the prescription I gave back then was that you should be automatic enrolling at 6% and escalating 1 to 2% a year up to a cap of 15. Now that's become more commonplace in terms of conventional wisdom now, but back then it was much more rare. And so the clients that I had back in the day that were safe harbor plans, in number, I probably had 7 to 10 clients that were QACAs, because I was like, look, we're going to do automatic enrollment, automatic escalation. You bought into that already. You have a safe harbor plan. Why don't we turn it into a QACA and take advantage of that 2-year vest? And a lot of clients like that. So again, it was pretty rare. Relative to the number of clients I work with, it wasn't super common, but it was something that I typically pushed when clients embraced automatic enrollment, automatic escalation.
Yeah, good point. Good point. Thanks. So the next vest we see is cliff vesting. So basically, you can set that out to 3 years. So an employee has to work for at least those 3 years to be 100% vested in that matching component. And then you have a graded vesting schedule. The most popular one we see is 6 years. So the employee after 2 years is 20%, and then so on up until you hit that 100% at the end of that 6th year. And again, vesting is a great tool to use to incentivize longevity in your employees. If you are running that safe harbor, unfortunately, for your match component, they are 100% vested. But if you also couple a profit sharing on, that's when you can add that vesting requirement to your profit sharing component of your plan, and then incentivize those employees to stay longer, so that way they get that full profit sharing component. Or in the cliff in a regular matching type scenario, a traditional stretch, you can add those vesting components as well.
I would say, Cliff, a good way to think about this, and again, this comes down to the demographics of your plan, but also your business, right? So much of this is not just kind of a set it and forget it and check the box. It's being intentional about your design. But with the cliff vesting, as Kevin said, you can set a 3-year cliff, which means that people receive matching contributions, but it's an all or nothing. If they leave before 3 years, they forfeit the entire match that you gave them. Once they get to 3 years and beyond, they're 100% vested. So if you're looking for longer tenured employees, you can use that cliff. And let's just say, your average tenure is 2.5 years. Well, obviously people aren't getting to that 3 year. That may be where you want to do a cliff vesting, because that encourages them, to stay longer. If you have, really long tenured employees, you might want to do the graded vesting on like the profit sharing contribution, where graded simply means, if you did let's just say you did a 4-year graded vesting schedule, they would vest 25% every year. So after a year, they'd be 25% vested in their match. After 2 years, 50. After 3 years, 75. And at 4 years, they would be 100% vested in any dollars that went in from a matching perspective.
So this is something as a plan sponsor where, work with your advisor. You just understand what your company makeup is, right? Are people coming for 2 years and leaving? Or are they staying for 10 years? It's not an issue. Have that conversation and just understand which of these three might be best for you, I think is the best takeaway here. And Kevin, here we have one more of these charts sort of showing what I believe this is how long before participants are 100% vested in the match is what it looks like.
Yeah, exactly. And again, if you look at all industries, you have the majority of plans are immediate, and that's because you have a high number of plans out using the safe harbor. And then when you scroll down, you get down to 5 or more than 5 years, and that's because, again, the most popular vesting that I see out there beyond after the safe harbor is of course the graded vesting schedule.
Good, and we'll move on to eligibility and entry, and we're going to get into some of the autos as well that we just mentioned. But Kevin, talk us through this a little bit.
Yeah, so eligibility and entry they go hand in hand, and some folks think just because they're eligible that means they're able to enter. So you can play with your eligibility and also your entry to stagger out when folks get in the plan. So again, I think this is where you really have to look at the demographics of your plan, the types of employees, the type of industry you're in. Do you have a very high turnover industry, or are you in a very low turnover industry? Do you have a lot of longevity with your folks? So if you're in a very low turnover industry, you might want your folks to get immediately into the plan and then enter immediately. So make them eligible and then enter them immediately. If you have a very high turnover, so most folks don't last, past 90 days. I heard of a plan I was talking with that they said that they've had folks that come in and don't even last a full shift. So that would not make sense to be an immediate eligibility and immediate entry plan, because you'd have some very small balances which are not fun to keep up with. So again, I think this is where you really have to be intentional. You're going to hear that word a lot today, intentional with how you design your plan and then how you monitor that plan.
Right. And I would say that most, the immediate, and one of the important things here, this goes back to, you need to make sure that your internal processes match whatever your plan document states. Most commonly, in the way I often advise clients was, to make eligibility immediate. And I think we've seen that as a much more common trend, is that people are eligible immediately, first day of hire, but that their entry is like first day of the month following the date of hire, because administratively it gives you time to get them into the plan. And Kevin mentioned in our kind of pre-call discussion was that there's even some record keepers that can't do immediate day one, and so you want to give yourself some administrative flexibility and freedom to get people into the plan, because when you don't, for instance, you wind up having what are called operational failures. So much in the industry we talk about the risk of fiduciary liability. The reality is that is in the realm of the large plan market, is when you come into real litigation risk, somewhere probably the $200 million plan threshold. The biggest risk for smaller companies is not the risk of getting sued, because these cases, when plans aren't big enough, there's no punitive damages under ERISA, which is the law that governs retirement plans. And so, plaintiffs' attorneys aren't taking on small plans because they can't make any money. The bigger risk is what are called operational failures, where you have to go in and you have to do what's called a voluntary correction. The IRS and the DOL have these voluntary correction programs. And what happens is when you, let's just say you forget to enroll somebody once they become eligible, you have to correct that failure. And the way that you do that is you have to go back and calculate the gains and losses that a participant experienced by not being able to join the plan because your internal process didn't match what your plan document stated. and those can get expensive. You know, I had a company I came across one time that had a $600,000 operational correction because they had mismanaged their plan internally for like a decade, and we found what the issue was, and it wound up being a real disaster financially for them. So whatever you do, make sure that your processes match your document, your plan document.
That's a great point, Josh.
Yep, always important. And this is just one more stats page here on eligibility and entry, so you can kind of see what the more standards are, the more norms are. And again, Kevin really focused on the top left of this page again, it looks like.
Yeah, I mean, again, that's because of some of the plans, you know, are safe harbor as well as, you know, a lot of these plans, overall industry have looked at their demographics and found that they can support that immediate eligibility. And then, you know, you see what's almost 60% are immediately coming in or within the first 3 months. So that would support, you know, that immediate eligibility with 1 month entry. Like Josh said, the first day following that 1 month. So good data there.
Mm-hmm. And now we're going to get into the auto features that we just mentioned a few minutes ago. And this is, for those of you who have followed along with our webinar series, we've talked a lot about over the last 2 or 3 months, Kevin, about Secure Act 2.0 and how these auto features could become requirements in new plans. So talk to us a little bit about auto enrollment and auto escalation, because these are huge trends right now.
Sure. As Josh mentioned earlier, auto enroll and auto escalation really came out with the Pension Protection Act in 2006. So it's exactly what it says. It's you are automatically enrolling your employees at a certain percentage, thereby forcing that employee, if they do not want to participate, they have to take action. They have to go in and make an affirmative election to not be in the plan. Prior to the Pension Protection Act of 2006 and auto enrollment, you, the employer, the plan sponsor, had to actively go after these folks and say, hey, do you want to be in the plan? This way, it puts all of, you're taking an active step to help people plan for retirement, but the employee has to take that step to say, no, I don't want to be in, and you have a documented record of that employee saying, no, I do not want to be in the plan. And if you see the stat here, 1 in 8 participants opt out of auto enrollment, which is great. So again, it's that power of inertia. You're doing all the hard work for them, putting them in the plan, and then, you know, they stay in the plan. And auto escalation works essentially the same way. You were saying every year at a certain point that the plan is going to put another % of your money into the plan. It can be more than 1%, but minimum's 1% up until you hit a certain cap, typically around 10% of the employee compensation. So, you know, if a plan starts out, I'm going to auto enroll you at 3, we're going to auto escalate every year at 1% until you hit that cap of 10%. Then the employee again has to take no action. They really don't even see the effect. And the stats support that auto escalation really works too, as 1 in 5 opt out of auto escalation.
If I could just make a couple of comments real quick.
Of course.
If you look at the industry data by all the large record keepers, I cite a lot of that in my book, The Fiduciary Formula, that came out in 2020. But Vanguard had an interesting stat in 2019 when they looked at their entire population of plans that they were the record keeper on. The average voluntary enrollment plan, right? So where somebody has to come in and sign up for the plan, had a participation rate of somewhere around 50 to 55%. The average automatic enrollment plan had a participation rate of about 90%. And so I think one of the important things here is, you know, these are really about creating guardrails. People can always opt out. And sometimes plan sponsors feel like this is too heavy-handed, but what I will tell you is that this is the trend, kind of the best practices, is design the plan where if people, you know, it's people have a hard time controlling their behavior. People are much more likely, as you see by the data, not to opt out if they've been enrolled. What the stats say is about 10% or so of people will opt out. And what's interesting is they'll opt out regardless of what the default rate is, whether it's 3%, whether it's 6%. The people who are going to opt out no matter what. but what volunteer enrollment plans typically show is that when people do sign up on their own, they tend to choose a higher contribution percentage than if they're automatically enrolled. And that's typically because companies set the default rate. So once you choose automatic enrollment, you have to choose a rate at which you're going to default. Historically, especially right in the years after the Pension Protection Act, you saw 3% as a common default percentage. What you've seen over the past few years is that more and more companies are either doing it at 6% or they're changing from 3 to 6% because they saw people didn't really opt out. The other thing is you always want to pair automatic escalation with automatic enrollment, because if you don't, here's what you're going to see. 2, 3, 4 years out from the people being defaulted in, they're going to be stuck around whatever that default rate is, because people don't proactively make changes. And so if we talk about trying to get people into that, call it 10 to 12 percent deferral rate so that they can be in that 15% total contribution rate, you really need to pair automatic escalation over time. And the important thing in this is, you know, people can always opt out. You're not holding a gun to their head and saying you have to do this. People can always opt out if they want to. The fact of the matter is they typically don't. Even if people are automatically enrolled at 6%, the people that opt out are going to opt out no matter what the default is, like I said. But if somebody's defaulted at 6%, what you see in the data in the industry is that people won't opt out. They may just back it down. And very few people actually back it down. Most people stay at whatever you set and design. That's where they're gonna stay. So people do feel there is pushback every now and then from employers who say, hey, this feels like it's kind of big brother, big sister. But if you want to drive outcomes for your people, and if you keep in mind the goal is helping them retire successfully, again, you need to get them in the plan participating as soon as possible. You need to get them to meaningful contribution rates and savings rates as quickly as possible. And the way that you do that, it's not through education. People think you will change things marginally through education. People know what they should do. They just can't control their behavior. Automatic enrollment, automatic escalation, the data is incredibly strong. It works. It drives outcomes. It's really hard to argue against them.
And these are great tools too. If you have a current plan, you're not employing the safe harbor provisions, traditional match, stretch match, and you're having testing failures.
Yep.
These are great tools to employ. It's a plan amendment. You can do what's called a re-enrollment campaign and add the auto enrollment, add the auto escalation, re-enroll everybody. And that is a real good driver to help you with some of those testing issues if your demographics do not support safe harbor. And we have another table here that just shows, you know, it's about 50-50 right now, plans that are using auto enrollment versus plans that aren't. So some of these plans, you know, that have been out there for years prior to the Pension Protection Act of '06 haven't employed auto enrollment. A lot of new plans have come on post. So that's why you see the kind of split. And then what I think is interesting too is, again, as you go upstream in the overall market, you see more and more and more of your larger plans are going back and employing auto enrollment, and the same data will support auto escalation as well.
Yep, exactly, and that's that one as well. And you're exactly right. So same concept, same story. It's increasing as you go to the larger size of the plan. So these are growing trends right now. These, again, part of Secure Act 2.0 that's floating out there in legislation right now that has not been voted upon. These might even become mandatory for companies that are starting 401k or retirement plans. So more to come there. I want to jump into fees first, and this is obviously an important part for you, the plan sponsor. Understand them, right? Who are they? Who are the providers? What are we paying? How does this make sense? Kevin, show us what's on this slide.
Yeah, so basically, I mean, if we look at ERISA, so the Employee Retirement Income Security Act requires employees to maintain a high standard of care and due diligence. So basically, that means you've got to look at what's in the best interest of the plan participants and their beneficiaries, and that involves monitoring the fees involved for every person that works with the plan. So your record keeper, your third-party administrator, as well as the investments. So you know, so you have to show a due diligence process in selecting those providers, ensuring that the fees are reasonable. ERISA doesn't state that you have to have the cheapest plan. It just states that you need to be able to justify the expenses you pay for the services or the performance that you receive. So you have to disclose those fees to your participants, and you have to show a monitoring process on an annual basis to support those fees.
And can I just jump in and make one comment?
Yeah.
Most people, when they go to buy a car, they never pay sticker price, right? If you pay sticker price for your car, you got screwed. Right? It's a negotiation. And I would say the interesting thing is most companies pay sticker price for 401k plans. I know that the Trust Company of Tennessee has a really good process around this, but realize that fees are negotiable, and you should be negotiating on behalf of your plan and on behalf of your participants. Ben Franklin said that small holes sink big ships, right? And you know, high fees can take a really big bite out of retirement savings and retirement income over time. The DOL has stated that you know, fees can reduce account balances and in turn retirement income by up to like 28% per year. And so I would just tell you that, you know, fees are negotiable, and it's not something where you just kind of set it and you forget it. You need to be thoughtful. You need to be intentional. One of the reasons a lot of companies do not negotiate around their fees is because most fees are paid through the plan. It doesn't hit your P&L as a plan sponsor. So you don't actually pay for most of the cost of your plan in most cases. It's probably the participants. And what I would tell you is, if you know you get kind of a benefit there, there's a reason why you probably try to negotiate, or you're much more dialed in and focused on what you pay for healthcare, right? Because you can't, that hits your P&L. Well, take the same mindset. Even if you pay the fees through the plan, still take the mindset from a fiduciary perspective that act like it was hitting your P&L, and then respond and analyze and negotiate appropriately. And really good advisors like the Trust Company of Tennessee can help you do that. And you can save vast amounts of money for your people over time.
Yeah, and you know, to that point, Josh, there are fees that you, the plan sponsor, can pay. So the advisor fee, the record keeping fee, the third party administration fee. There are fees that you cannot pull from the participant, which is the investment cost, the mutual fund expenses. But when possible, if the business can pay those fees that they can pay, it's always better for the business to pay, because that's a bottom line deduction for the business. But most importantly, that benefits all of your participants in the plan, because you have taken a lot of the cost of the plan away from them, and they will see those account balances grow faster because there's less fee erosion.
There's a really good narrative around that as being an employer of choice. And you know, I think the other thing is, like, this isn't kind of a binary either or decision. Like, you could put into place, like most companies with healthcare, right? They do some type of cost sharing arrangement. So you know, as Kevin said, anything that's as considered kind of an admin operational expense, there are certain expenses you can't pay. They're called settler expenses. We won't get into that. But you do have the freedom of putting all the costs through the plan. But I would tell you that as Kevin mentioned, you know, what you're really trying to do with this benefit is be an employer of choice. And so it doesn't need to be all or nothing. We either pay all of the advisory fee or none of the advisory fee. We pay all of the record keeping fee or none of the record keeping fee. There are ways to do some type of cost sharing arrangement. And the key here is you want to get credit, right, with your benefits. How often do we provide benefits? I know with my company that I ran for 17 years, you know, a lot of times we offered benefits, and in many cases, people didn't really appreciate the benefits we offered. And we were constantly fighting this battle of, we would spend money on these benefits and they may not be utilized all that much, or they weren't really appreciated. And so much of this is around the narrative and creating a communication to kind of put this in context to help your people understand the benefits that you offer, how competitive they are, the things that you're doing to actually help and contribute to their success. When you do that, it creates a lot of loyalty, but you have to put it in context. There was a GAO, the Government Accountability Office, did a study, and they published the results a couple of weeks ago. And 41% of employees still think they pay nothing for their retirement plan. Well, that's crazy. Nobody works for nothing. And so if you ask somebody, like, if they don't have any context around the fees they're paying in their retirement plan, they're going to think that any fee is basically too high. But if you can come in and you can put context and say, hey, here's what the average plan of our size pays, and here's what we pay or what you pay, there's a great narrative. And it's all about merchandising. So much of benefits is about marketing and merchandising. So take steps and use your advisor to help you put it in context, to help your people understand and appreciate what you're doing on their behalf.
And I love just putting this in terms of real numbers. You know, whether you're reducing fees by taking on some of the fees for the participants, or you're just as a plan sponsor or a committee, you're really monitoring these fees or negotiating the fees or whatever it might be, and bringing those fees down. Kevin, we see a real impact here in terms of real numbers.
Yeah, I mean, this slide just really illustrates the impact on somebody who's been in the plan. If you read all the stats at the bottom, they started at 25, average salary of 40,000. 3% annual growth, annual contribution of 10%, retirement age, they start taking money out. So this money has grown and grown and grown. And you see what the impact of just reducing the fees by 0.5%. So that's an additional 106,000 or 5 years of retirement income. Or if the fees are reduced by a full percent, it doubles that savings and then more than doubles the amount of additional spend in years. So, you know, I would say from what this slide really illustrates to me is that, you know, if you're trying to retain and recruit and reward your employees, you know, do whatever you can to help minimize those fees that impact their, you know, your employees' success over the years.
Exactly. And with that, we are going to get into the benchmarking piece that we talked about on the at the front end of this. So Lindsay, if you are back there, let's launch poll question number 3. And this is, when did you last benchmark your plan fees? Was it within the last year, 2 years ago, more than 3 years ago, or never? Josh, I'm going to spare you. Kevin, what's the answer here? What's the winner?
I would hope it's within the last year.
Yeah, and this is, you know, to the sponsors or the committee members out there, this is really where you rely upon that advisor role to come in and work with you and provide this to you, at least on an annual basis. So if you're not getting it, you know, okay, you know, not your fault directly, but just make sure you're reaching out to those providers saying, you know, as we're going to show you on the next slide, where is this? Can you show us where we match up to be sure we're doing our job and we're monitoring these fees? So we'll give it one more second and see what answers come back. And then we'll jump into an example of a fee benchmarking report that you, the plan sponsor or committee member, could possibly see. So most being within the last year, that's excellent. Your providers are doing what they're supposed to be doing for you, or you're doing it yourself. Either way, it's great. And then, you know, some sporadic answers between 2 years ago to never, and that happens too. So again, just best thing you can do is reach out to those providers that you have right now and say, where is something like this right here, Kevin, which is a fee benchmarking report that we provide. It's not the only one that's out there. It's not meant to be the model or the best or whatever it might be, but just something that'll show you where you fall in fees. So can you walk us through this briefly, Kevin?
Sure. So, you know, this particular type of benchmarking report compares plans of similar asset range. So you can see it's comparing this particular plan at 7 million to plans between 5 million to 10 million. And then there's also another page to it that actually looks at similar participant count plans. But this goes down in ranks by percentage. You can see you have the blue shaded area, you have the green shaded area and the orange, and then you have all the different total plan fees, investment management, custody, all the way down the line, the different services offered. And you see the amount of plans that's been in that universe. And what you don't want is you don't want to see yourself fall in every single blue area, because the cheapest is not always the best, as we know, and you don't want to be all the way over in the orange on every aspect. You see the kind of the middle line is the green, and this plan hits almost in the green in just about every aspect. And that's what you really want to see. That way, you know if you get questioned about your plan, or if you have a DOL audit, you can come in and say, hey, listen, this falls within the reasonable guidelines, and we feel like we get the services that we need for what we're paying.
And I would just add that if you responded that you haven't realized that benchmarking is not is not the goal or the outcome. Benchmarking is a tool that you use. The goal or the outcome is to negotiate a good deal for your plan, given the factors based on whether that's, you know, assets or number of participants. What we've seen is that, especially in the smaller end of the market, I would say under like $20 million plans, most of the record keeping fees especially are asset based, which means that, you know, as assets grow, record keeping fees grow. And what we've seen over the past year, just with the markets, is that, you know, plan balances are elevated. And what that means is, you know, if your plan assets have doubled over the past, you know, 1 or 2 or 3 years, then it's likely your record keeping fees have doubled as well. And so now is a good time, when kind of the market is, or plans are at a kind of peak level, is a good time to go back. And what you're seeing trends wise is the move, especially record keeping fees, is to move away from asset based fees to per participant fees. It aligns the scope with the work. You know, a record keeper, in my opinion, shouldn't be charging an asset-based fee, because if plan assets double and they have the same number of participants, well, you know, they still have the same, they send the same number of statements, you know, their website, their work hasn't doubled, though their revenue has doubled. And so now would be a really good time, if you haven't kind of tended the garden in a couple of years, is to go back and pull some of the weeds.
I definitely agree. And then if you're in that kind of never category, I mean, if you haven't benchmarked your plan, how do you know you're offering the best plan possible to, again, retain, recruit, and reward those employees? And also, if you were to be audited and you've never done a benchmarking, that, in my opinion, that would be a green light or a red light for somebody to say, well, if you aren't even simply benchmarking your plan and making sure your fees are reasonable, what else aren't you doing inside this plan? So that would be time for a deeper dive by a DOL or IRS auditor.
Great point.
That's right. And anybody on the call who is not currently receiving a fee benchmarking report, or who never has, and they want something to send to their providers, reach out to us. We'll send you an example of this to give to them and say, give us something back sort of like this, to be sure that we're monitoring this each year. Guys, we have got some really good slides at the end that I want to be sure that we get to, and we're coming close on time. So if you don't mind, we're going to get into this investment section and probably just cover this one slide. The other slides go into talking about how the importance of monitoring your investments once they're selected, understanding what they are, and sticking to the process. And those are equally important to the slide we're looking at right now. But for the sake of this, Kevin, let's really focus on maybe the most confusing part of all to the employee, to the participant, which is number of funds offered and some things that are covered on this page.
Yeah, I mean, you want to make sure that you have all of the, what we call in the industry, size and style boxes, so types of funds covered. But you don't want to have so many funds out there that your employees can't make a choice. You know, they're like, oh my gosh, paralysis by analysis. You don't want to offer 5 large cap growth, 5 large cap blend, you know, and so on and so forth. So you want to make sure that you have an appropriate coverage, and that's exactly what your advisor should be doing for you, saying, hey, this is the appropriate funds for each size and style box. You have a great amount of funds here. We offer about 25 funds on our plans, and we feel that's the perfect amount. And then we offer different ways to invest. So, you know, you see at the bottom, target date fund, do it for me. That's what I like to call the set it and forget it. It looks at somebody's age and their target retirement date and puts them in a certain fund. So just like for me, I would be in like a 2045 fund. I don't have to touch it. Every 5 years, the manager of that fund, you know, scales down the amount of risk by lowering the amount of equity or changing the types of equities that are being invested in. And then again, I don't have to do anything for it. We have risk-based portfolios, which is, if you take a risk test, you might be conservative or you might be completely aggressive. And that is a fund that doesn't change over time. If it's growth, 100% aggressive, it's always going to be that way. And it's up to you, the participant, to work with that advisor on your plan to make changes as you feel like your risk profile changed. Or if you are somebody who likes to put it all together yourself, you really understand investments, you go through and you pick each of the individual funds to come up with your portfolio. Again, that you work with your advisor on the plan to monitor that portfolio and make changes as you and that advisor feel appropriate.
So, Josh, my wife started a new job about a year ago, and she handed me her 401k, basically enrollment kit, right? And there were probably between 70 and 80 funds. There were no target date funds. I work in this industry, right? And it still took me 45 minutes to put this together. And like Kevin just mentioned, I'm choosing between different large cap managers and things that just people who don't do what we do don't and shouldn't even know about. Is that still way too common?
In the smaller end of the market, absolutely.
Okay.
And there's a tremendous amount of behavioral research that shows that, in fact, there was one study that showed that for every fund added to a plan above 10, it reduces participation by 2%, and increases the probability that a participant will allocate 0 to stocks by 3%. And so, too much of a most people like ice cream. If you like ice cream, you only have one flavor, vanilla, and that's it. You're probably going to get tired of it over time. But if you've got, too many flavors, it's going to be really hard to make a decision. So I like what Kevin said, and what you're seeing trend-wise is that fund menus, because of the behavioral research, they're starting to become more streamlined, and the studies have shown that you need to have enough funds to create a diversified portfolio, but when you start adding too many, it starts to impact participation rates and how people invest. So yeah, I totally agree.
Got it. So we got just a few minutes, and Josh, you've got some slides here. Get some frame
Yeah.
on me as I scroll through these, but I wanted to get to these, and then we'll close out. But walk us through what you have here.
Yeah, so this was before I sold my firm. This was a study that I did in amongst our client base. We had about 50,000 participants in our client base amongst our 130 plans. And this was a survey that I created, or that I sent out. And I just want to highlight a couple of things. We got incredible response to it. So we had about 1,900 completed responses across all types of size plans and by industry. Couple of interesting things, and you can see, there was good breakdown in terms of, I wanted to look at the different dimensions of the responses by gender. So it was, 56% were men that responded, 44% women. By age, and so I broke it down by early career, mid-career, and late career. You can see that about 3/4 of the people were early mid-career, so that's under 55, and then by income. And so it was, again, if you look at about 60% or so, about 70% were under $100,000 in income at the employee level. But it was a comprehensive survey, 70 questions in 10 different categories, and it was a comprehensive planning survey. So not just about the 401k or not just about retirement. And what's interesting here is if you look at the studies on survey design, what you see is that when a survey goes above 25 questions, above 40 questions, responses drop to about 25%. Well, this survey had 70 questions, and the completion rate was 89%. Now, that's not because I designed the best survey in the world. I think what was interesting is this is on the hearts and minds. Financial wellness is on the hearts and minds of employees. And we got an incredible completion rate because people cared about this and they wanted to make their voice known. So if you go to the next slide, Zach.
Yeah, gotcha.
Financial stress is real and impactful. Your people are very likely to be feeling financial stress, especially coming out of the pandemic. In 2019, almost half of employees said they felt financial stress on a regular basis. And when you looked under the hood, and I did the analytics on the data, it was it was enlightening and scary at the same time. So people who had financial stress were 17 times more worried about running out of money. They were more than 50% more likely or less likely to have an emergency fund to help them weather the storm when unforeseen expenses came up. They were almost 3 times more likely to be worried about debt. They were 16% less likely to be saving for retirement. And this is where you want to think about it from an ROI and from an impact on the work product as it relates to your business. People who were stressed were 5 times more likely to say that stress had impacted the quality of work, which directly impacts your business. 33% were less likely to feel like like their employer cared about them. They were 56% more likely to believe that their employer's benefits were less competitive than similar organizations, and they were 45% less likely to feel like they were confident that they were taking full advantage of the benefits that you offered them. So when you start thinking about being an employer of choice, when you start to think about attracting and retaining talent, when your people are stressed, it's going to impact how they view you as a company, how open they are to looking at other companies where they think maybe the grass is greener, and ultimately, and most importantly, most likely, it's going to impact the type of work they do for your customers and for your clients. What was also interesting is when I surveyed and asked questions about what they were looking for, overwhelmingly they wanted objective fiduciary advice and support. So only about 26% of people out of the 1,900 actually had access to a financial advisor. Not surprisingly, I think this is what jumped out at me the most. The reason people are stressed is because they don't have a written financial plan. Only about 0.25% of people surveyed had a written financial plan. Many people, the vast majority, about 95% of people, they wanted help. Only 6% of people said they didn't need help. When I surveyed, I put 15 benefits, so not just retirement, but things like healthcare and telework and student loan, all these different benefits. The number one thing people wanted was a larger retirement contribution. They wanted you to be more generous. Number two was 15% of people said they wanted a financial wellness benefit with access to unbiased counseling and advice. And that number has been going up because financial wellness is a hot topic. The number one thing people wanted, 75% of people said they wanted access to digital financial planning tools. And 65% said they didn't just want education meetings, they wanted one-to-one advice meetings. And here's what's interesting is you're seeing advisory firms. I know the Trust Company of Tennessee has a really good financial wellness and participant engagement benefit. You're seeing all the big record keepers that are trying to roll things like this out as well. But 39% of people said that they believed an independent fiduciary advisor was the most trustworthy source of financial advice and education. Only 12% of people said they thought that the most trustworthy source was a record keeper. And so what I would tell you is financial wellness isn't a retirement benefit. It's an employer benefit. It's comprehensive. It's not just about the investments and about retirement. It's about debt. It's about budgeting. It's about risk management. And the best way that I think it can be delivered is by an independent advisor, not by the record keeper. So I think this is fascinating. I think what we're seeing is if you want to be an employer of choice, you have to start thinking about wellness for your employees. And there is an ROI. It's a softer ROI, but when you start thinking about quality of work, when you start to think about people's willingness to look elsewhere, if you want to be an employer of choice, you should be thinking about financial wellness as an employer benefit, not just a retirement benefit.
Thank you, Josh. That's great stats. And yes, I think that's marching order there is to touch base with those advisors, capture this information, be sure that that is being provided to your employees, because we've talked about the hiring atmosphere right now and the environment for it. It's difficult, right? And we have to provide every benefit that we can to them. So Josh Itzo, best-selling author, expert in this field, founder of 3 companies as it relates to this field. Thank you so much for being here. Kevin, thank you for joining me and your work going into this, and to all of you on the call. Thanks for being here. Gentlemen, and all on the call, enjoy your day, and we'll see you soon.
Thank you.